Why do businesses overpay on taxes? My name is Artem. I am a CPA and the managing partner here at Torrent Accounting. We really appreciate you watching. Most business owners think they overpay on taxes because they miss deductions. Occasionally that's true, but usually that is not the real problem. In our experience, working with growth-focused business owners, the real reason people overpay taxes is because their business structure never evolves as the company grows. The entity election stays the same, compensation stays reactive. And tax planning happens maybe once a year instead of being designed as a long-term strategy looking far out. Today, we want to walk you through what we call structural tax architecture and why the structure of your business matters far more than small deductions, although don't miss the small deductions. Most owner-operators start the same way. They launch a business, they form an LLC, and then they stay in that structure for years while the business grows, never looking at changing it. The problem is that the tax structure that works at $100,000 of income is rarely the optimal structure at $300,000, $700,000, or $1.5 million. As revenue scales, the tax architecture should evolve. But for most businesses, it doesn't, which means the owner ends up paying taxes based on a structure that no longer fits the size of the business. Let me give you a simplified example. Imagine an owner-operator generating $600,000 in net profit. If that business is operating as a disregarded LLC, so they're filing a Schedule C, then essentially all of that income is exposed to self-employment tax, an extra 15.3%. That means the entire amount flows through and is subject to Social Security and Medicare taxes. Is anybody going to get Social Security these days? Now, compare that to a properly structured S-corporation election. In that structure, the owner pays themselves a reasonable salary, and the remaining profit flows through as a distribution to the owner, not subject to the self-employment tax, if structured properly. So let's use, for example, a $600,000 profit, a $220,000 reasonable compensation. The remaining profit may avoid self-employment tax exposure. That's great news. That can produce meaningful tax efficiencies when structured correctly. Now, of course, compensation has to be reasonable, depending on what you're doing, and this should always be modeled properly. But for this example, it illustrates the concept. Structure matters, and you should be proactive about it, not reactive. Another way to think about tax planning is through the inflection points that you see during the year. At different profit levels, different strategies begin to make sense. As an example, around $300,000 of net profit, so that's income minus expenses, it usually makes sense to evaluate S-corporation modeling depending on what that business is doing. Around $750,000 in net profit, business owners may start exploring layered entities or advanced retirement strategies. And once a business reaches $1.5 million or more in net profit, tax planning often becomes much more strategic. That may involve retirement integration, liquidity planning, and long-term exit strategies. The point is that tax strategies should evolve alongside the business. Ideally, you don't have to go to your CPA and ask him, what can we do better? Your CPA is reaching out to you. So what does multi-entity architecture look like? As business scale, many eventually move toward multi-entity structures. This is where architecture becomes more strategic. And you may see structures that get a little exotic, such as an operating company that runs the business and manages the payroll, a holding company that owns the assets and the capital reserves. There's typically a real estate entity that owns property and leases it to the operating company. And sometimes an IP or management entity that handles licensing or management functions. And this type of architecture can help. And it can help with the following: risk isolation, asset protection, strategic tax planning, and long-term capital planning. Now, this strategy is not for everyone, so I just want to make that clear. So you really want to consult with your CPA to make sure you're planning correctly. Structural tax planning typically becomes relevant when a business reaches a certain scale, which we have previously discussed, and we're going to go over here in a second. Generally speaking, this is the most relevant for owner-operators generating $500,000 or more in revenue or businesses producing $300,000 or more in net profit. At that level, and sometimes before, depending on the scale of the business, financial impact and structural planning can become significant. For smaller businesses, simple structures are usually fine. A lot of times people overcomplicate it and they end up overpaying in tax preparations fees. And so the biggest takeaway is this: most business owners do not overpay taxes because they missed deductions. Most, not all. Make sure you have good record keeping. But they overpay taxes because their structure never evolved as their business grew. Good tax planning is not about reacting every April and calling up your CPA to yell at him or her, which you can do with us. We'll take it. But hopefully we're not in that boat. It's about designing a structure that supports the next phase of growth. And when done properly, that structure becomes the part of long-term strategy for the business. Again, my name's Artem. Thank you for watching if you made it this far, and I will see you on the next one. Bye.